Right, so you've joined us again with Sam Tyndale and Eddie as well to discuss the spring budget for 2024 as well. See if there's, what we can sort of pick from it really, because there doesn't seem to have been much gone on in the budget. We were just saying that it seems to be a bit almost fluffy, I think, really, isn't it? The best word. He's not really gone for much. And again, part of me thinks certainly watching it as well, it seemed to be very much like they're trying to go down the election route where they're trying to pick fault with Labour and stuff like that. But then again, he's given us sort of a few giveaways, sort of the national insurance, the ISAs as well, as well. So what are your thoughts on the budget?
First of all, thank you for having me on again, and thanks, Ed, for coming out your way to record this. Very much the same. I think the issue we've got now is that I don't think there's any clear lines between what is a spring budget and what's an autumn statement. Bear in mind, this was always meant to be the impactful one, and the autumn statement was just an ABR requirement. But I think because of underlying politics and trying to sort of drum up popularity, I think they've taken both in the past 6 months as an opportunity to try and politically point score. The actual budget itself, for me, didn't have... NI, again, is the biggie, but outside of that, there weren't any huge life-changing things that happened. I think, from our perspective, as you say, some movement around the ISAs is interesting, but we'll go on to talk about it practically. I'm not sure how much difference it'll make. What I think is really interesting is that the pressure that consumer finance and spending has managed to put on this budget. So Martin Lewis is becoming a household name now. I saw he got an award the other night for the journalism award, and he has directly influenced some of this budget. The child benefit, high income tax charge changes were most definitely driven by him. I mean, he had a call from Rishi Sunak before the budget to tell him that it was the pressure from his show that had made that change. So it's just interesting to see the government listening to opinion, and he seems to become a voice of the people. So regardless of your views on him as an individual, I actually think he's achieved quite a lot for the public within this budget. So I suppose a natural place to start for me probably is with the high income child benefit changes. Because of the fact, if out of anything, that budget that has been driven by Martin Lewis. So effectively, the rules we've had to date are that anyone earning more than £50,000 and up to a ceiling of £60,000 would have lost their child benefit over the course of those £10,000 of earnings. The rules have always been considered very unfair because you could have two households earning £49,000, with virtually £100,000 worth of income, and they would have their full child benefit, versus a single income household earning £60,000 who get no child benefit. Where they didn't go, and I know this was a big hope for the budget, is that they'd go to this, as opposed to addressing one individual house, they're going to look at joint household income. And I definitely think, it was said in the budget that is a place they're looking to get into.
For April 2026, aren't they?
That was
it'll be interesting to see how they actually work that through at the moment. Is historically, what we've in the past, we've had quite a few clients where husband and wife have both been earning, and they've both been wanting to earn sort of sub the 50,000 between each, because there's obviously that ceiling that once they go over the 50,000, they start losing the child benefit. It just seemed, on its original inception, it was a very almost at times ill thought out plan, really. They're almost penalised at that point. It felt like they were penalising the hard working family and stuff like that.
Working families for sure. If you think of the sort of traditional, you have children and someone stays at home to bring up the kids and someone works, it's always punished that family, and there's a lot more that can be done to help working families. This is definitely a step in the right direction. I mean, effectively now they've moved the threshold from £50,000 to £60,000, and the rate at which you lose that will be less. So the lower limit is 60,000, the upper limit is 80,000. So the bracket is much bigger.
So you've got a lot more sort of playroom. So instead of for every £100 over the 50 over the bottom threshold, you lose 1%. It's now every £200 over, you lose that 1%, which it does help a bit. But then again, it will be interesting to see what what thresholds they put in for the household toasters, and again how they're going to actually police that as well. So which I think that's probably going to play into the Making Tax Digital for income. The
visibility there.
Yeah.
I think one point I'd always make to anyone is that even if you aren't eligible for child tax benefit, if you do earn more than £60,000, it is important to still claim it and either not receive the income or to have the income taxed back off you as part of your self-assessment. The reason being is that it still gives you a credit for your national insurance towards your state pension. So, and it's not uncommon that we see in households that you've got somebody out there working, earning £60,000 a year, claiming child benefit in their name, when in their relationship their spouse is at home and they're not earning and they're not claiming child benefit. And in that situation, you've effectively got someone at home who's not getting a credit towards it. So it's really important at whose name you claim child benefit in as well. So, just an opportunity for everyone to make sure that they're doing that within their family.
And definitely as well, because if they're not getting the national insurance credits at that point, they've then got to look at class 3s, which are historically quite expensive, really. You're looking at £17 to £20 per week for that year to backfill, which is, if you can get the credits for free, and then even to the point of having the child benefit paid into a bank account, and then just transfer that straight into a savings account. So at the end of the year, you've got to pay it back to the tax office. You've still got those credits for that earner or for that non-earner in the family sort of thing. So
I would say probably the last point with child benefit. I mean, I think we could both agree it's a positive move.
Yeah.
I think they do need to look at how they apply it to a family. I think that's going to be really important. Whether they looked at the lowest earner in the house, but we'll see if they're going to be that generous. The other point that's always been there in the past, and hopefully I think will be there in the future, there's no reason why it wouldn't be, but it's using pension contributions. So really simple exercise. If you're someone who earned £55,000 a year under the old rules, and you were losing half of your child benefit, you could set up a salary sacrifice arrangement with your workplace, give up £5,000 of your salary and have that paid directly into a pension. And in doing that, you would then be entitled to reclaim your whole child benefit. It's a rule that I'd like to think most people know now, but we still see it time and time again where people aren't aware they can do that. And I would say that the marginal rate of tax relief when you're doing that is about 60%. So it's an absolutely huge saving, and it's one of those ways pensions can work in your favour. But appreciating the fact that obviously the stress and pressure that families are under with the cost of living and things like that is is not always a solution if you need that income. But it's just something worth noting, I think.
Likewise with that as well. If you're entitled to expenses through your work as well, you can, if you've had to buy tools and stuff like that you're actually entitled to claim that expense back, or the tax allowance for that expense back from your income. Again, that can help reduce down your threshold for child income or child benefit charge and stuff like that as well. So
that's probably a natural shoehorn into capital allowance.
It is,
not really my area, so I'll happily bow to the greater powers on this one. So, over to you on capital allowances, Dave.
Yeah. So again, we've obviously got if we're looking at sort of capital gains tax allowances and stuff like that, a nice one that we've had there where we had a 4% drop in the higher rate for capital gains. So when you're selling, say, a second property, or you're selling a taxable item that's a property, you would have paid 28% on anything that's over the or into the high rate band for tax. That's including your actual income tax income as well. So the fact that they've dropped it by 4% is nice. It's still not brilliant, really. I think we're probably going to do a bit more with that because, again, it's. But then I can see that they are trying to sort of bring in the. Trying to stimulate the property market again. I think that's the key thing.
Most definitely. Yeah.
They're not.
I read that. I think house sales and purchase were down 15% in 2023, which is a pretty staggering number.
Yeah.
Obviously, the amount of companies that are involved in, the sale and purchase of properties. And all the subsectors surrounding it. It's the biggest mover of money in the UK market. So it's always. We were saying, it's difficult because with property, they want it to grow, but they don't want it to grow too much. And if it grows too much, and first-time buyers can't afford it. If it doesn't grow enough, makes it difficult to roll out any sort of tax changes or stimulus. So that sort of is the Goldilocks of taxation and property growth, really.
And again, that's another thing that of interest was the removal of furnished holiday lets as well, the allowances. Again, I know it's going to simplify it, but it also means that they're not going to get those allowances. It's not going to. It almost pushes the viability of those furnished holiday lets out of the window, really. And again, it was a nice bonus to have, but again, it was always a case of how long is this going to last for, because you knew at some point that the government was going to go after it, really, and that then frees up more of the properties in those sort of rental holiday market areas, sort of like the Devon and stuff like that, and Cornwall.
Realistically, no one locally is going to go out and buy. If you a one-bed flat in Cornwall for £800,000, it's definitely not going to be in the locals market.
That's the thing. You're looking at it, thinking, well, I know the area you guys are trying to sort of stimulate, yet the local aren't going to be able to afford that. And in fact, even some of the people in the surrounding areas aren't going to be able to afford it. I'd be surprised if anyone from outside of London could actually even afford to buy a property in there. I think that's going to be pretty much a damn squib. Although, again, the idea of trying to stimulate it with the drop of the 4% drop, it's still not going to be brilliant sort of thing. And again, I still think that you're going to have a nice little shoehorn into the non-dom regime replacement as well. Again, I think a lot of the property owners are offshore, and the idea that they're going to replace it in April 2005 with a new option as well, where after 4 years, it's you're looking at the removing the remittance basis, i.e., when you bring the money into the UK, that's when you get taxed. It's actually going to be. You have 4 years, tax-free in the UK, and then you're going to look at being taxed on your actual income or worldwide income. Again, I think that's lending itself more back to the MTD for ITSA and stuff like that. So they're going to have to find ways of monitoring and recording it and policing that as well, which, again, it'll be interesting how they try to do that. So I'm just thinking about it. Do we look at sort of what wasn't covered by the budget? I saw the stuff that he didn't bring through. Obviously, they're still halving the capital gains. Dropping 6 to 3.
This is a big planning point. I've been having this conversation a lot with clients lately. To me, so capital gains tax exemptions historically were £12,000 a year, gone to 6, going down to £3,000. And give it a really basic example. If you've got a direct share that you hold, £100,000, if that share increases up to £103,000, you're going to be into capital gains tax territory, which is really, really low, and it doesn't give a lot. You're talking about a 3% return now. The stock market last year, on average, is probably up about 10% for the year. In an average sort of medium risk portfolio. So, that would have pushed the average investor with £100,000 straight into capital gains tax. I think the importance of tax wrappers, the structures that people use for their investments going forward is going to be really important. between now and the end of the tax year, capital gains tax management. So, what can you do about it? Well, if you've got a portfolio, an unwrapped portfolio, a unit trust, an OIC, a general investment account, varying different terms out there. But if you hold one of those types of investments, if you've not looked at any fund switches to trigger those capital gains, now's the time to do it.
Yeah.
Even selling down a fund into cash and then going back into that fund after 30 days to avoid your bed and breakfast rules. Something like that. If you've not obviously utilised your ISA allowance and you hold unwrapped investments, I would like to think that everybody would be doing that as a sort of just natural tax planning. But in making that sale from a general investment account down to an ISA, you're crystallising gains at the same time. So I think the opportunity to try and use that £6,000 exemption now, ownership of those investments, if it's a single, if it's an investment in single names versus investment in joint names,
you got to
one set of capital gains exemptions versus two. Whilst this is all sort of very fund focused, it's amazing how many people own rental properties that are just in a single name and have not necessarily considered moving that asset around between spouses and partners. So I think they're all options to consider. I think the biggest thing, though, is going into next year with this £3,000 exemption, it's almost the opposite. That, if you're looking at a portfolio and you're looking, say you've got a £150,000 investment portfolio, you go to make a fund switch, make a change to that portfolio, it's going to be really, really easy to inadvertently trigger a gain. It won't have had to have grown by much, and all of a sudden you're going to be stuck with a capital gains tax bill. From a planning perspective, there is no one-size-fits-all answer on this conversation. It is just engaging with your professional engagement, whether it's a financial advisor or a tax partner, accountant, whoever you work with. These are the type of conversations you need to be having with them and making sure that there isn't any inadvertent gains, because capital gains tax can be quite complicated, particularly where you've got a portfolio that's been chopped and changed and switches and movement of funds. It can be quite difficult to keep a track of that. So I just think it's something we've really got to watch. The only tie I'd make to the change to the higher rate of property CGT down to 24% is that I wouldn't be surprised if we had future changes in governments and CGT was on the cards. It's one of those things that in the run-up to most budgets, CGT gets put on the table, and it wasn't that long ago that we were talking about aligning it with income tax rates. We should see you having a maximum rate of CGT going from 28% to 45%. So to me, I still think, maybe opportunistically in the next tax year, if you were going to offload a property anyway, if you were looking to sell, that actually doing that in the next tax year where it is slightly less, because most property gains probably are going to be in higher rate tax, that is the time to maybe take advantage of that. I don't think it's enough to go out full sale and decide to offload a load of property. If you were trying to move one on anyway, it'd be a better time to do it than not. So, I think the same as we said last time we met, things like stealth taxes and not moving allowances. Again, I don't know if you want to go over the headline rates, but not a lot's changed there.
No, it's still dropping the dividend allowance from £1,000 to £500. Anyone who's got shares, it's almost a pittance, really. Again, no change to the national insurance thresholds, so they're still 12,570 for Class 1 employees, 9,100 for Class 1 employers, national insurance. And again, no change to the IHT limits as well, no change to corporation tax thresholds either. And even though, granted, it's dropped 2% off the national insurance, it's still, again, we're looking at minimum wage, 37.5 hours a week, is £22,308 a year before tax, and your 2% saving on that is £16.23 per month. When you look at the average weekly shop for this year, is £74 per week. That's not even covering that, is it, really? I was chatting to one of the guys, one of our clients yesterday, and they were saying that doesn't even cover Xbox Live for a month.
These are the first world problems.
When you're looking at kids, you think that's not even covering the subscription for that.
we're getting V-Bucks for that.
No, they'll be moaning about it. And even someone on 50k, it's £62.38 a month average. So again, that's not even your weekly shop. You say, not even a tank of petrol. And that's as much as they sit there and the headline is, oh yeah, you save £748 a year. Well, that's per year. When you look at it on the monthly rate and the general the cost of living crisis and the increase, it's still nothing.
I think some of the expectations for things that were likely to change that didn't were the high rate threshold. Because how many years? It's been a few years now that we've not seen an increase, and obviously that's another one of those stealth taxes, that sort of fiscal drag. So I think one of the other topics that was quite interesting, and whilst not life changing, but something new to talk about, was the introduction of the UK ISA. As with a lot of these things, we get the news in the budget, then you go to the HMRC landing page to find out a little bit more, and what does it say? Absolutely nothing. It's in consultation till the 6th of June 24. What do we expect from it? Well, it'll be a £5,000 allowance. It'll sit on top of your £20,000 current ISA allowance. It should have all the same benefits, being income tax-free, capital gains tax-free, and the whole point is it's meant to be for investment into UK companies. So how do we see it working? Well, it'll just be another form of ISA allowance, which is my only frustration, because it's getting a bit awkward already with lifetime allowance, with lifetime ISA, normal ISAs, junior ISAs. They're just bolting on an old level of. They could almost do with starting this all again, and they got challenged last time about where do. They brought lifetime ISAs in, thinking it was going to be some replacement to pension schemes, and they've just sort of trundled along. They're not really being utilised. This is obviously another addition that we've got to deal with. How do I think it's going to play out in practice? Will it achieve the goal that they're setting? I don't think it will. I think that they want investment into into the UK. Now, if all that means is that to qualify for an additional £5,000 of ISA subscription, it's got to go into a UK fund. Well, a lot of the UK funds invest in, the FTSE 100, for example. And is that where they want the investment, or do they need the investment down into smaller companies? Now, if they want the investment down into smaller companies, and they're offering £5,000 additional ISA allowance, but they're not giving any further tax benefits, and the risk profile is increased by investing in smaller companies, people won't want to do it because it's not attractive enough to offset the risk that you take.
That's the thing. Do you want to go into the AIM, or do you want to go into the FTSE 100? And it's, a lot of people go into the FTSE 100 because they're a lot more stable, getting ready to your peaks and troughs, but you've got a much more safer return out of those than you're doing the AIM and stuff like that, or the alternative investment market. It's again, you start to feel is this just like another throwaway? Look at this, we're investing in British commerce.
It's a good idea in principle. I'm just not sure that it will. I'm not sure. I don't want to say that our industry will take advantage of it, but I feel like our industry is going to see it as, we can get another £5,000 in an ISA for clients, and are we going to specifically be interested in the fact that that's invested in the UK? Being totally honest, I don't think professionals are. I think professionals, we're interested in trying to provide growth for our clients, trying to manage risk and trying to plan tax efficiently. Where that investment isn't, I wouldn't say it's too much of a concern for us. The interesting thing, and I can see why they're doing this, I mean, if you look at a lot of funds that are out there, and this is a sweeping generalisation, but a lot of the funds that are out there now is sort of medium risk managed equity funds. The asset allocations are very, very heavily overseas. I can speak for our portfolios at St James's Place. A lot of our medium risk portfolios are far more weighted into North America than they are the UK. And that's just because that's where the investment committee believe that returns are going to come from. That's where we see growth. America offers more growth, generally speaking, than the UK. I was actually, I did a presentation this morning. I was going to include a slide that showed what happened on the UK markets in November, what happened in the stock markets in November and December 23, because it was quite fascinating really how quickly things shot up over the course of about 6 weeks. And I put a couple of indexes on there. I put the MSCI World on there, and I put FTSE 100, and I was trying to indicate how much growth was achieved in the last 2 months a year. Well, actually, when I looked at the FTSE 100, it achieved 0.53% for the whole year versus the MSCI World is 16%. So it didn't exactly back up the argument for investing in the UK. So, but that is quite telling, and if you look at returns now over the last 10 years, the overseas markets have dominated the UK. Part of that issue is because of the fact that people used to be attracted to investing in the UK markets, particularly FTSE 100, because the dividend yields were very attractive from FTSE 100 companies. Now, COVID came, we came crashing into that. FTSE 100 companies cut their dividend yields, and they haven't really instated them back to the point that they were at. So that's made it less attractive for income investors as well. So all in all, I think it's going to be challenging. I think they could get it right, and consultation is going to be important. Listening to the industry is going to be important.
Definitely, yeah.
I think potentially financial services are going to be on a different page to the government with this. I think we're just going to see this as how can we easily use this allowance
how can we get
invest
more
for our clients. And the UK, I think, are going to want to see how can we ensure that investment goes into the UK and there needs to be a compromise. They're going to have to look at the structure of funds that invest in the UK and where they invest in the UK. So I think it's complicated. Yeah, it's what I sum it up as. So, but that for me, that's the UK. I said the bones of it are £5,000 extra. Should be income tax free and capital gains tax free. Will sit on top of your normal £20,000 ISA allowance. Yeah. Solely for investment into UK qualifying funds and companies, but that is all we know at this stage.
Yeah, it'd be interesting to see what the qualifying UK funds and investments will be and stuff like that. How they're going to monitor and maintain that, and also what sort of returns are our clients going to get from that as well. Yeah. It's a nice idea in principle. Yeah. Once we get it through, again, it's just waiting on the government and waiting on the departments to release what they're going to do with it, sort of thing. So,
from a political perspective, I did notice reading a couple of articles last night, in preparation for presentations and these discussions today. A lot of the comments on there were, great, an extra £5,000 of ISA allowance for families that can't already afford to save £20,000. So I think politically, again, unfortunately, it's probably missed the mark. And I appreciate we try, I always try not to be political in these conversations because that's not what the budget's meant to be. But I feel like we get dragged in politics.
So. Certainly watching the budget live yesterday, it felt very
noisy, a lot of shouting, a lot of arguing.
It was almost like at times akin to a primary school sort of thing, primary school playground. And again, that's not been trying to be political. It was very much. Yeah, I heard order far too many times really yesterday. At times it felt like it was very much like a political point scoring exercise, certainly with some of the comments that Chancellor Hunt was making towards Angela Rayner and stuff, certainly to do with the property sort of that side of things as well. But again, it is interesting to know that this year is going to be an election year. I think that they've tried to gear it up for an election. I wouldn't be surprised if we're looking at June, July. Based on this, again, certainly with the British ISA allowance or British ISAs coming in June, July, it'll be. I think that's what probably what we're looking at. If he probably calls it an election in August, I wouldn't be surprised because they're going to say, "Oh look, we've just brought this out," and then just in time for the election, sort of thing. So. It'll be interesting to say the least. So
I think the only other thing on ISAs really, and we touched on there just briefly, is the lifetime ISA. So again, a lot of campaigning from Martin Lewis and the team at Money Saving Expert for lifetime ISAs. And the problem with them at the moment is that the idea of lifetime ISA is you save £4,000, the government add in 25%, so £1,000, and you can do that every year, and you can do that from the age of 18 to 39. So theoretically, towards buying a first-time property, it's an incredibly attractive investment. There's a couple of caveats in there. One is the value of the property is limited at £450,000. Now, we're joining you today from sunny Lincolnshire, where £450,000 is a decent budget as a first-time buyer. Yeah. But if you're down in the city, it doesn't go very far. And not only that, there is a penalty to the interest when you do buy a property that's above £450,000. So there were a couple of areas that Martin Lewis was campaigning against. One of the issues you've had over that period of time is that since 2017, house prices have gone up 30%, whereas we haven't adjusted that £450,000 allowance since that point. So in theory, that has lost 30% of its value against the property market. So there's a couple of easy fixes there, isn't there? Increase the maximum limit for the value of a first-time property. Increasing the age profile, 18 to 39, incredibly restrictive. I don't have the statistics in front of me, but I read something the other day saying that only sort of it was about 10% of people by the time they're 27 have bought a house. So actually, if the upper limit for buying a first-time property is 39, some people might only just be starting that journey. So I think the whole thing needs looking at. I do think, and apparently Rishi Sunak has come out and said that they are going to look at lifetime ISAs. And there was his comment to Martin Lewis was that there was a whole planned package of stimulus for the property sector, but house prices have been uncertain, sales haven't been as fluid, and they need to see stable recovery of property prices before they're willing to bring in anything further. So I think there will be changes with the lifetime ISA. I've spoken to a lot of clients who just don't seem to be aware that they're actually a product that's out there. The range that's available is relatively limited. That's part of the difficulty. And from the industry's perspective, the government brought out the Help to Buy ISA. Loads of providers ran to the market, spent hundreds of thousands of pounds generating this new product, which was the Help to Buy ISA, and then the government scrapped it. And they've all wrote off probably quite a lot of losses on that. So then they announced the Lifetime ISA, and the industry just went, oh, we're going to wait. Let's see if this actually sticks as a product. It has now stuck for several years. They don't seem to appear to be giving up on it. I just think it needs a bit of a rework. And I think if they get it right, you'll see that the industry will bring more to market. I was with a client the other day. We were looking at some of the available cash lifetime ISAs that are out there, and a lot of them are the sort of online platforms, the sort of newer, more technology-based, app-based platforms. And for them, they felt that wasn't what they wanted. They wanted a more, they wanted to be able to go to a bank, they wanted to be able to get one, and their bank, not that I won't name the bank, but their bank didn't offer one. And actually, when you look sort of broader sector, there's some of the biggest mainstream providers, both cash and stocks and shares based lifetime ISA providers, just aren't entering that market at the moment. So it's a bit of a watch this space, I think.
That sort of speaks volumes as well as to the more traditional bank sort of approach to it as well, isn't it? If the big banks are really adopting it, it kind of almost stunts the growth of that lifetime ISA as well. And again, certainly with the 18 to 39 age group, there's again, capping it at 39 is going to, is sort of limiting your market because certainly with the cost of living crisis and the cost of rent and stuff like that, there's not going to be many people who are under the age of 39 thinking, I need to buy my first house, or be able to buy my first house when they can barely even afford a week's shopping sort of thing.
I think the one sort of closing message with Lifetime ISA is that if you are 18 to 39, you are buying a first-time property, it is under £450,000. Let's not overlook the fact that a 25% overnight return, and theoretically, if you're investing in cash, no risk attached to that other than inflation long term, but no capital at risk. That is an incredibly attractive proposition to boost your deposit. So and something that people should definitely not sort of sleep on.
Oh yeah, definitely. It would have been brilliant if it was around when I was looking at my first property. It's like, I'm a bit annoyed now. I've missed it.
It's a bit cheap about that, though, weren't
they? I'm looking back at some of the parents' faces and I'm thinking, it's 5-figure houses. You've got 3 beds and stuff like that. And it's nowadays, you're lucky if you get it for less than 250k, aren't you? Really? So I think the last bit we're going to touch up on is the increase of VAT threshold in the budget, which We had more, admittedly, I'd hoped for more, certainly from the accounting profession.
Quite small, wasn't it?
Oh, no, 5,000.
Bit underwhelming.
Okay, from 85,000 to 90,000. It will help quite a few clients out there, but again, we had hoped for, around 100,000. Ideally, it would have been 125,000 to be more in line with the thresholds for sort of tax-free allowances and stuff like that. But again, 5,000 is not to be sniffed at, but it's still not great. We're still going for quite a few clients that are still in that threshold. And again, on the flip side of that, the deregistration threshold has gone from 83,000 to 88,000 for a 12-month period. It's not ideal, really, but it's something, I think.
For a simple man like myself, and being in a service that's largely VAT exempt, what is the implication of hitting the VAT threshold? What does that mean to business?
So yeah, for quite a lot of businesses, it's obviously when they hit the VAT threshold, they've got to charge VAT, which is 20% on top of your sales. And normally, what happens is businesses get themselves into that market where they're charging the price is what it is. Then they have to charge VAT, and they can't turn around automatically and pass it on to the clients. So some will split the difference and reduce their price. Increase the price by 10% overall, but then that other 10%, because they're having to collect 20% VAT, they're having to reduce their net income by 10% in order to cover the VAT that they've got to pay over to the taxman.
Are there any pros of being VAT registered?
From a sort of professional standard, it looks nicer if you're VAT registered. Certain councils and larger government organisations won't work with companies unless they are VAT registered. But then again, for most sort of day-to-day smaller businesses, they're charging them to the end client, and the client, the consumer, they can't recoup the VAT generally, so they're having to think, well, actually, I can't turn around to my client and say, oh, sorry, this year I had to put another 20% on my charge because I've got to pay this over to the taxman. It's difficult because their consumers are battling with the cost of living crisis and stuff like that. And then the companies, in effect, they lose almost 20% of their sales trying to pay the VAT over to the taxman. Yeah, granted, if they go down the standard route for VAT registration, they recover the VAT incurred on their purchases and stuff.
I was going to say, do you find that? I suppose it's business by business where that's useful. Going through doing some renovations at home. Yeah. I find that virtually everything we buy is subject to VAT, and obviously as an individual, it's quite a lot of cost. I assume that certain businesses, it's nice to get that back, but it's in one hand and out the other.
It's all swings and roundabouts. I mean, like for an IT contractor, it's by the by. I mean, they've got very
I'm buying anything.
Hardly ever buy anything. And some of the software that was already because they're buying the softwares outside of the UK, there's no VAT on the sort of software suppliers and stuff like that. Whereas if it's a builder and it's a builder's merchant, they've already got VAT, so they can recover that. But then also you've got a domestic reverse charge for VAT for certain builders as well, so that already stings them for that as well. I had hoped that another sideline is they've done something for the hospitality sector with regards to VAT, but again, there's nothing in the budget for that. And with the hospitality sector already being squeezed as is, and then they've now got national minimum wage kicking in, going up from £10.40 odd to £11.43, and it's not just from 23 years and up, it's 21 years and up. So that's going to be a massive cost increase for those guys, and it does worry me really. And again, they could have done a lot more, I think, with the VAT thresholds for that. So
my last question with that was, and this might seem like a really obvious one, but I assume this is on group undertakings, and not you couldn't just have one business and get that up to 80,000 and then start another one and take that up to 80,000.
If you have a look at sort of VAT groups and stuff like that. So if they're all owned by the same,
there's no avoiding.
No. There's obviously we have here mumblings of people trying to disassociate companies, so they're splitting the companies to split the income. If the HMRC thinks that's what's happening,
It's a big red flag.
yeah, it's a very big red flag. But then again, on the flip side of that, if they're two separate entities in two completely separate sectors, then they make sense for them to be trading separately and stuff like that. So,
Like most things in our world, a conversation needs to be had.
definitely, have a conversation with your tax professional and see, what we can do to help advise you on that, because there are pitfalls and there are scary sort of things if you're not careful, sort of thing. So, yeah.
Super. Well, I've really enjoyed breaking down the budget with you. It's been enjoyable as always, and I think whilst it wasn't the most exciting budget, I think if you were to take the content from the last two budgets, the statement and today, and put them together, there's quite a lot there. I think the biggest risk from my perspective is that actually in this sort of drip-fed information and new rules every 6 months, if we take this approach, it's a lot for businesses and people to keep on top of. It's 2 points a year where there's a sort of new set of rules. So I think that does make it tough for business, and hopefully these type of conversations are helpful for people listening.
Welcome to the guys, and thank you again for your time as well. It's always good to get the financial side of things as well. I mean, obviously we can talk wax lyrical about the tax side of things, which granted is not the most exciting areas, really, is it? But it's one of those necessary evils. And then, from the financial side of things as well, we can look at actually what this is going to cost our clients, and it really helps as well. So it's brilliant. So thank you again.
No, brilliant. Thanks for having me.
Cheers again.